So I heard about this morning as well. I think it was Amrita Sen who said high interest rates are causing people to liquidate inventories. So I guess inventories are just flowing into the market. So it's not that demand has actually been that weak, she said, and maybe you can confirm that, China and whatnot. It's actually just that supply has overshadowed that.
Well, it's not a phenomena that's unique to oil. We see it in copper, metals, in the entire commodity complex. There's three factors driving this. One, higher funding costs. You can't hold a physical or a financial position. You think about cash, the cash return is 5.25% risk-free. That's your competition to get somebody to hold a physical barrel of oil or a financial paper barrel of oil. Second reason, the recessionary concerns. Why do you want to keep inventory around if you're concerned about a recession coming tomorrow? So we continue to destock both the physical and financial barrels. And you put it all together, it's nearly 1 billion barrels of destocking over the last year and a half. So it's substantial. And if you look at like floating storage of Iranian barrels, sanctioned barrels that we've been waiting a decade to be discharged are being run down. So basically, the market is destocking any and everything it can get its hands on. The one thing about oil, it cannot go on, and we're getting to nearly the end of it. And what's going to happen is the physical market's going to pop. That makes the return for holding oil once again profitable, and people will likely unwind those short positions, rebuild some of the physical inventory that's being destocked, particularly on the metal side. You're at critical levels right now. And that's why we continue to be positive going into the second half of this year, is this destocking just cannot keep on going.
It's fascinating because other industries that got burned in the pandemic are keeping higher than normal inventory levels, and yet in crude and in metals, it's much lower than normal. What are the long-term consequences of that? More price volatility or upward price pressure? Or when was the last time we were in such a situation?
Well, we've never been in a situation where we've seen 500 basis points of an increase in rates in such a short period of time from such a low level. And so you think about just like what the cost of holding a barrel of oil is. You got to borrow the money to finance the position, call it 7%, and then your lost cost of cash is another 5.25. So you're losing nearly 13% by holding that barrel of oil. That's a very unique time period. So when we think about what it's going to take to get somebody to hold a barrel of oil or a metric ton of copper, is you need this market to start moving higher and make oil become an asset as opposed to a liability, because right now it's a liability. So ultimately, the physical market will get tight enough such that it begins to pop. You unwind those shorts, pushes it higher, and then you have more of the trend come back into the market. Our target is fair value 3 months out is $89 a barrel. We're 97 at the end of this year. So if you get back up to those levels, then oil starts to become an asset again, as opposed to being a liability.
So we've been talking all about the supply picture, but what has demand been like since Jan 1, as we now should have enough data to know whether China's reopening fell flat or actually contributed to still a decent amount of demand, or how's that affecting the markets?
Here's the stat I love to throw out. The IEA has raised oil demand forecast every single month since November of last year.